the big move that's happened is overseas. When you see German bunds hit a trough of negative 70 basis points, I think they're negative 24. So that's been a really healthy move because that's clearly not good to have full bond market negative yields. But also kind of going back to the original yellow light. I mean, we put client capital to work. We run a wealth management business. As we have new clients onboarding, I think, lump sum investing is hard to do and dangerous to do. You don't know if it's 1999 or 2002 or what have you. And so you dollar cost average, right? And that's what most people do is when they invest and they have cash, we're going to put some money to work now. We'll put a time period and invest that money over the next 6 months, 12 months, take advantage of those opportunities. I think that's where we're on the same page.
Absolutely.
About that comment about don't put money to work. Yeah. It's not binary. Investing is so nuanced. And so I think most people would say, let's dollar cost average and take advantage, but not try to time the market because that's just a fool's errand.
You see that, and that's where I disagree with the Wells Fargo note. I agree that it always pays to focus on your risk. But to say try and time the market melt up, that's not how I'm looking at it. It's dangerous to try and time a market sell-off. Try and time anything in the market. So you need that strategy. Now, I don't have to be invested. I don't have to keep putting capital work there. I can put capital work anywhere I want. But I look at the equity market as still the best place to be in the short term. I wouldn't be surprised if rates came down again.
I don't expect it. On that note, though, they're worried about just getting too optimistic. They upgraded the banks in September. They faded low volatility exposure. OK, those things are working. They say typically when everything is going right, it's about to go wrong.
Right. And I'm not criticizing, but I still think that there's enough of wall of worry, as we started out saying, where it's not. I don't think you need euphoria for the market to sell off. There are plenty issues out there without euphoria. There's Elizabeth Warren, but that's not for 6 months or so. That's not going to be a real factor until then. So take that off the table. People like to talk about it. It's not on the table for 6 months. We still don't know who's going to be the nominee or who's going to win. So what do you have? The only thing you have right now, the Fed's off the table, is China trade. Period. You're through earnings.
You could say it's good that the Fed's off the table,
it's
right?
Terrific.
Yes.
I mean, that's a huge difference this year versus last. I mean,
Market's prepared for the Fed to be off the table, right?
Exactly right.
And by the way, off the table really should mean we're not getting another cut. I'm not sure the market is really priced for that.
But maybe it's coming around to that point of view that Jay Powell, for all, is right.
I think it's priced for that for sure.
Look at the leading economic indicators have bottomed. The PMIs globally are bottomed and starting to pick up. That China's getting better. The U.S. is getting better.
Rates moving up would suggest that the Fed's gotten it right.
Absolutely.
Correct.
Let's pat them on the back.
The economy's improving, exactly.
That's what I mean.
Yeah.
There's no reason to have your foot on the gas of cut.
Yes.
For here to eternity anymore.
And we're still not at a high enough in rates where you're going to see money come out of the equity market to go into those yield-bearing instruments there.
But Farr mentioned all this money on the sideline, which we mentioned yesterday.
I don't know if that comes back. I don't think you need it to come back.
Well, what gets it back? That's what I want to know. What brings it all back?
It's been there for years.
One of two things.
Phase 2 or phase 3?
One of two things.
Sorry.
Market corrects 10%. That money's going to come in. There's disciplined money out there. And then there's the euphoric trade.
You told me that we're not going to correct like that.
Why? I didn't say that at all.
You said we got a green light.
What? No.
You don't think so?
No. See, okay, so this is what money managers do. And to me, experienced money managers will look at you and say, I have no damned idea what this market's going to do over the next month, 6 months, or year. I truly don't.
Do you feel like the environment is right for a move higher between now and the end of the year,
I can see
3-4%?
I could see exactly how it could happen. I could see how we'd be down 10% by the end of the year, too. I can make both arguments. What I have to do...
What's the probability? You, like everybody else, deals with probability. What's the probability that that's going to happen?
The path of least resistance, in my opinion, is higher. I mean, this market, in spite of all of these short-term corrections and bad pieces of news where we have these down 300-point days, it's just marched higher over the last 10 years, 10 months.
If the path of least resistance is higher, do you need the kind of money that Farr is talking about is on the sideline to come into the market to push it there?
No.
Well, so listen, so when you have going back in time, when was the Business Week article, 1982, the death of equities?
Yeah.
And so if you look at from 1982 to 1999, the S&P averaged 18% per year for 17 years. But from a fund flow perspective, 90% of the money came in from 1996 to 1999. And so how many people actually experienced that 17-year run? Very, very few. And so I think it's a very good question. What's it going to take? I think ultimately you have that fear of missing out. But you also have, if you look at the target date funds, right, as you have more and more retired investors, I think there's close to $1 trillion in these target date funds. They're naturally, with clients out without investors doing anything, going more and more conservative for those baby boomers. So it's definitely a headwind. That money won't be coming back unless the clients move out of those target date funds and explicitly go into equity.